This is a video regarding investments in financial assets, the fair value option, and some exercise in equity investments. Now, before we go on, we need just to talk about investments in general for a few minutes. In this case, when we're talking about investments, we're talking about in financial instruments, and these are financial instruments that are typically issued by other institutions or other companies. Now, most companies invest in financial instruments, as I said, issued by other companies. And for some investors, investing companies, these investments represent ongoing affiliations with companies who the securities are acquired. As an example, AT&T may acquire investments in Bell South. A company like Nextel may invest in certain companies to gain forms of internet access. Now, on the other hand, some investments are not made to garner favorable business relationships. Rather, they're simply to earn some form of return from the investment, such as dividends from equities, such as common or preferred stock, or interest from bonds that have been sold by companies. In effect, the same type of rewards that might entice you personally to buy these shares of stock or this equity or this debt in the form of bonds may be the same basis that the reason another company would buy these instruments. Now, with such a large diversity in investment objectives, it shouldn't come as a surprise that there is really a fair amount of diversity in the approaches used to account for investments. And you're going to see that investments are accounted in 5 ways, and I'll just give you a verbal listing right now. These would include what we call a hold to maturity, trading securities, securities that are available for sale, accounting utilizing the equity method, and lastly, accounting regarding consolidation. And we'll talk about those here in a little bit more detail as we move on. Now, before we go into the details, let's take a look at what is called the critical events associated with an investment. There's basically 4 critical events. The first one is the acquisition of the investment, where we normally record the investment at the market value for which we paid. We're going to record that typically at cost. Also, the second event then is recognizing revenue, when we're going to recognize revenue from the investment, and that's typically going to include dividends for equity and interest for debt. Thirdly, there's a holding period where we're going to hold the investment, and in that case, that's a period in which the investment's value can actually change, and this can result in unrealized holding gains or losses during that holding period. And the fourth major critical event is when we sell the security or sell the investment, and at that point in time, we have realized gains and losses from the sale of that investment. Now, this is a rather complicated chart, and we'll go over it in detail, but this basically provides us the 5 different reporting methods that are used on investments by the investor. Now, what you're going to see here is investments can again be broken up into 2 major categories. First one being debt, and that is when a company buys another entity's debt. Debt is typically in the form of bonds. Equity, which would be in the form of common stock and some forms of preferred stock. Let's take a look at the debt side first. When we purchase debt, we have two options. We can value the debt at cost, or what we call the fair value option. Now, in the case of cost, it would be the amount that we're willing to pay for that debt, and we may have an adjustment and then subsequent amortization for a premium or discount on that debt. On the other hand, we can elect to utilize the fair value option. Now, I should point out that we simply can't pick and choose these particular options as we want. We have to declare how we're going to report these particular investments or these securities at the time we purchase the securities, and we can't simply change them from period to period. There has to be certain criteria met. If we have to change a security, basically a way of reporting for any particular reason. So let's assume now that the company elects the what we call the fair value option. Now, if you take the fair value option, you can basically you have three different options to choose from. The first one is if you intend to hold the security to its maturity, that is called a hold to maturity reporting type, and we'll talk about the accounting for that in the next couple of slides. On the other hand, your purpose may be to actively trade in that debt, actively trade with those bonds in order to earn some form of income or achieve some other strategic objective. Under this circumstance, we would declare that these particular investments are called trading securities. I have it written down, abbreviated as the TS. Now, there can be a third category of debt investments, and we call that other. And those are what we call AFS, available for sale securities. And these are classified as securities that have been purchased, and we're not planning to hold them to maturity, nor are we planning to actively trade them. So this other category is kind of a catch-all, that if it doesn't fit in HTM or TS, it's going to fall into the AFS. And again, we will talk about how that reporting type is accounted for in the next couple of slides. Okay, now we take a look at the equity side. And there are three levels of equity classifications here. And in the case of between 0 to 19% of an equity's voting stock, the generally accepted accounting principles say that the investor lacks significant influence over the company. Now, it's important to note that significant influence means the power to participate in the operating and financial policy decisions of an entity. So what the FASB or GAAP says is the presumed influence between 0 and 19% of the voting stock is the company really lacks a significant influence. Now, what we really need to look at, and this is in another lecture, but when we want to classify these investments as to influence, we also have to look at the actual influence, because that's what trumps everything. A company may own 12% of another company, yet the people on the board of directors of that investing company may also be on the board of directors of that investee company, and therefore there's probably be a very, very strong argument that the investor has a significant influence over the investee, even though we hit a 12% ownership. So it's the actual influence that counts. These other method basically this methodology for the percentage of influence is presumed influence, and actual influence trumps presumed influence. And again, just let's assume that an investor controls 90% of a company. So pretty much that would mean the investor controls the entire company and there'd be a case for consolidation. But it could be that the investee company is undergoing a bankruptcy at the moment and it is actually under the control of the bankruptcy trustee, which means no matter how much the investing company owns in it, it still doesn't control that company. It's controlled by the bankruptcy trustee. So there's another example of uh, actual influence versus presumed influence. So let's start off right now. As far as we're concerned, we're going to be dealing with what we call fair value options. In other words, fair value accounting. So in this case, what we're going to do is for our purposes right now, we're going to ignore the cases where the investor is able to exert significant influence, and that's 20% all the way up to 100%. So let's go back up here to where it says the investor lacks significant influence. Now again, when we make an investment in common stock or preferred stock, in other words, an equity, we can either use the cost method or we can elect to use what we call the fair value option. In the case of the cost method, we record the investment at cost and we leave it at cost. If we record it at the fair value option, we have to decide whether it is classified as a stock that we are going to actually actively trade, and in that case it would be called a trading security or TS. Or we have to classify it as in the other category, which is something, it's a stock that we're not actively trading in, and that would be what we call AFS, available for sale type of security. Again, just like the equity investments, if we elect the fair value option, we have to elect the reporting time at the time we actually acquired the particular security. Now this slide is an illustration of pretty much what we just talked about. I'm just displaying it in a slightly different way. Again, a company is going to make investments, and it's going to make investments in either, if we will, debt or equity, or basically some other company's bonds or some other company's common stock or preferred stock. In this case, with investments, again, as I said, we can have debt or equity. And when we're talking about investments in this case, we're assuming that the investing company assumes no significant influence over the other company. Otherwise, we'd be accounting for that company on the equity method or through consolidation. Let's first take a look at, again, debt. In debt, we have three different categories. The first one is held to market securities, or HTM. And in this case, we have to understand the entity has the positive intent and the ability to hold this security to maturity. In other words, if this entity is really kind of cash starved and they're going to have to probably use this security or a combination of this and other securities to make payments later on, they may have the intent, the positive intent to hold to maturity, but they're not going to have the ability, so it wouldn't classify as a hold to maturity security. Debt can also be classified as a trading security, and these are, again, securities intended to be sold in the near term. And available for sale securities that are not classified as held to maturity or trading securities. Also, investments can be equity, and they can be one of two categories. Number one, trading securities, again, which are the securities intended to be sold in the near term, or available for sale securities that are not classified as, in this case, we wouldn't have held to maturity because that would only be for debt, but securities that are not classified as trading securities. Now let's take a look at held to maturity securities, or HTM. And remember, a bond typically has a security or has a date where the basically it has a maturity date. So typically hold to maturity only encompasses debt securities. And again, as I mentioned from the previous slide, the entity has to have a positive intent and ability to hold to maturity, and that again has to be elected when the security is purchased. Now, if we take a look at when we report the security as a held to market or hold to market, we are going to encounter the particular economic events on three different parts of the financial statements, or three financial statements rather. If we take a look at the balance sheet, okay, the investment itself is recorded at cost net of any premium or discount. And the investment itself may be classified as current and non-current or non-current depending upon the maturity date that we're dealing with. Now, the unrealized holding gains and losses in the market value of that debt security basically are not going to be recognized. We're going to just amortize the premium or the discount against the interest received over the life of up to the maturity date of the bond. So unrealized holding gains or losses in the market value of the debt security are not recognized until that debt security is finally sold. Just pretty much what you learned when you learned bonds, how to account for bonds in your intermediate accounting class. So again, looking at the three major financial statements, the investment itself is recorded at cost, net of any premium or discount. On the cash flow statement, the investment, the inflows and outflows are typically classified as an investing activity. And on the income statement would include any interest received plus the amortization of any discount or premium on the bonds. Now, there is an exception where, however, an investor may elect to record hold to market securities at their fair value, and then the valuations along with gains or losses are recorded as if they were trading securities. We'll talk about trading securities just in a few minutes. Now here's trading securities, and trading securities are securities purchased and sold to make a profit on short-term differences in price. And a lot of banks and financial institutions will trade in these on margins and spreads, and that's how they make some of their profits. So basically, trading securities are securities intended to be sold in the near term. And again, we can take a look at the areas of the financial statements which they impact. On the balance sheet, trading securities are normally classified as a current asset. They're typically initially recorded at cost. However, at each balance sheet date, securities are remeasured and revalued to fair market value. Now, with that said, let's flip down to the income statement for a second. Typically, again, income received in the form of, if we're talking about a debt, it'll be interest payment on the bonds with the amortization of premiums or discount. If it was equity, it's going to be dividends that are received for the stock in the case that we reclassify our tradings, or we place in the event that we reclassify our holdings. Thirdly, and this is what's very important, unrealized holding gains or losses as a result of remeasurement are recorded as a holding gain or loss in the income statement. So in this case, we recognize any change in the fair market value at the balance sheet date, and we're going to recognize that change in fair market value as an unrealized holding gain or loss. Now that's the classification within the income statement. It simply says unrealized holding gain or loss, so it still impacts the income statement. In the cash flow statement, this is usually an operating activity, although that could vary. Okay, now let's take a look at available for sale securities, or AFS. Again, these are securities that are not classified as held to maturity or as trading securities, so they're kind of the catch-all. And if we take a look again, the balance sheet and the income statement. Okay, if we look at the balance sheet, they can be current or non-current, normally based upon the maturity date for the debt and management's intent to whatever they're going to do with that security for equity. Now, when we take a look at an available for sale security, an AFS security, they're typically recorded at cost. However, at each balance sheet date, the securities are remeasured at fair value. And here's something important to remember. Unrealized holding gains and losses are reported in other comprehensive income, or if you will, accumulated other comprehensive income, which of course is reported as part of the balance sheet equity section. Now, on the income statement, realized gains or losses as a result of disposal are recorded on the income statement. And we also have to remember, so we don't end up double counting the information, we have to remove any of the amounts that were associated with the accumulated other comprehensive income from previous periods. That has to be reversed from our accumulated other comprehensive income totals. Now, for our income statement, again, interest, dividend, and amortization associated with premiums or discounts would be included on the income statement. Now we're going to take a look at some examples of some reporting on the different types of securities we just talked about, available for sale, trading securities, and hold to maturity. We're going to see how some of that works and see some journal entries regarding. Take a look at this where we have a hold to maturity security. Now, in this case, we're assuming the security had been purchased, and we're in this case, this security had been purchased. It's $5 million face value. It has a discount remaining at $100,000. So what we're assuming is that we purchased this bond obviously at a discount, and now we're selling it. So when we're selling it, in terms of recording the sale, we're going to record the cash from the sale, of course, and also the cost and the value of the securities removed basically from the balance sheet. The premiums and discounts on the bonds are eliminated, and there's going to be resulting gain or loss from the sale of the bond. And again, this is exactly what you learn in your intermediate accounting book when you're selling a bond that you've just invested in. So again, assume a $5 million face value. The discount remaining on the bond is $100,000, and we sold the bond for $5,250,000. So we would debit cash for $5,250,000. We would credit our investment in the bond for $5 million, and we would have a credit eliminating our discount on our bond of $100,000, which means in this case we would end up with the gain on the sale of bond investment of $150,000. Okay, now we'll take a look at the full transaction cycle with a full transaction cycle with a trading security. Now, in this case, we're assuming that we purchased some Buddy's common stock for $200,000. So we would debit stock investment for $200,000, and we would credit the amount of consideration that we paid for the stock, $200,000. Now, during the on the balance sheet date, we have to remeasure all of our trading securities to their fair value. Now we're saying the fair value of this stock investment has gone from $200,000 to $206,000. So what we would do is we would debit the stock investment for $6,000. So the balance of our stock investment now would be $206,000, and we would show here realized and unrealized gains and losses regarding our stock would be $6,000, and that amount would go directly to the income statement. Now let's assume that the stock was sold at some other point in time subsequent to the balance sheet date for $220,000. So when we're recording the sale, the cash from the sale, the consideration that we're receiving, is going to be recorded. We're going to remove the stock investment from our balance sheet, and there's going to be a resulting gain or loss from the sale of the stock that's recorded in the income statement. Now, in this case, we're going to debit our cash for $220,000. But remember, our stock investment is actually now not $200,000, but is $206,000. So we're going to credit our stock investment for $206,000, and then the remaining amount will be the gain on the sale of stock during this particular period. So that would be how we would, in basically a simplified version of how we would record a trading stock, the critical events in the trading stock. Okay, now let's take a look at available for sale securities. And let's again assume that we're purchasing stock at $200,000. So we would debit our stock investment balance sheet, and our credit for cash would be $200,000. Now also assume that we now have classified, at this point in time, we've classified the trading for security. The trading security is available for sale. So we have to report under that condition. Now, again, let's assume that the stock was remeasured at our balance sheet date, and the fair value is now $206,000. So now we remeasure the stock from $200,000 to $206,000. So our stock investment goes up by $6,000. The credit is to accumulated other comprehensive income. And remember, that's accounted for on the balance sheet. So we debit our stock investment for $6,000 and we credit AOCI for $6,000. Now let's assume that we're selling that security, the last critical event here. And in this case, when we record the sale of the security, the cash from the sale is recorded. We reverse the accumulated other comprehensive income associated with the pre-measurement from our balance sheet date. We remove the stock investment from the balance sheet, and the resulting gain or loss from the sale of stock is recorded in the income statement. So you can see the debits and credits here. We have a debit to cash for $220,000. That's the amount that we're receiving from the sale. We're also going to debit accumulated other comprehensive income for $6,000 to reverse out the effect. Our credit then would be to our stock investment for $206,000, and we'd have a gain on the sale of $20,000. And you'll notice the reason we debited the accumulated other comprehensive income, if we didn't debit that, we would end up double counting that $6,000 with the as a credit that went to AOCI, and the $6,000, which is a component of the gain on the sale of the stock. So let's go ahead now to question number 1. And number 1 says, Cone purchased bonds at a discount on the open market as an investment and has the intent and ability to hold these bonds to maturity. These bonds should be accounted for at, and you're given your choices. Go ahead, stop the video when you're ready to make your choice. Go ahead and restart and review the video again. Okay, number 1, basically the question is that these bonds should be recorded at, in this case the answer is B, amortized cost. And again, held to maturity securities, if the investor has the intent and ability to hold the securities to maturity, they're basically HTM held to maturity, and they're presented net of any applicable premium or discount, which would be amortized cost. Okay, let's try number 2. Blitz Bear Company had the following investments in trading securities at the end of the balance sheet date as follows, and you're given 3 separate securities with their cost and their fair value at the as of the balance sheet date. And the question is, what is the value of these securities at the balance sheet date? So again, stop your video. When you're ready, restart your video to view the answer slides. And in this case, again, what is the value of the securities at the balance sheet date for question number 2? And again, these are trading securities. They're initially recorded at cost, and then at each balance sheet date, the securities are remeasured at fair value. In this case, we measure the securities, each of the securities at their fair value, 8,000, 11,000, and 9,000. So the answer in this case is B, $28,000. Okay, let's take a look at number 3. On June 30th of year 1, Coma Corp purchased $1 million face value 8% bonds for $910,000 plus accrued interest. Accrued interest is a short-term investment. The bonds mature on January the 1st of year 8. At the end of the year, the bonds had a fair value of $945,000. In February of year 2, Coma sold the bonds for $920,000. What should Coma report for the value of the bond if it was classified as an available for sale security? So again, stop the video, and when you're ready, go ahead and restart the video and review the answer. Okay, the answer to number 3, basically in February of year 2, Coma sold the bonds for $920,000. What should Coma report for the value of the bond if it is classified as an available for sale security? So we take a look at the basically the description and the recording methodology for available for sale securities. They're initially recorded at cost. Then at each balance sheet date, securities are remeasured at their fair value. And as we mentioned previously, any unrealized holding gains or losses or accumulated other comprehensive income, but that's not what this question's asking. It's asking what should the value be of that bond. And in this case, the value of the bond at the balance sheet date, the remeasure was $945,000. So the answer would be C, $945,000. Let's go ahead and try number 4. Number 4, the following information pertains to year-end data for a company for available for sale, AFS, available for sale securities, and we're given years 1 and 2 and the cost and the fair value. The decline in fair value is properly accounted for in year 1 by what amount of other comprehensive income be credited at the end of year 2. So again, take a look at the questions. Stop your video when you're ready to answer. Restart the video for the answer slide. Okay, so the question here again for question number 4: by what amount of other comprehensive income be credited at the end of year 2? And the answer here is D, $30,000. So if we take a look between year 1 and year 2, cost is always $100,000 because the cost remains the same. However, there was a decline in the fair value of this available for sale security to $90,000 in year 1. Now in year number 2 then, the fair value went up to $120,000. So it went from $90,000 to $120,000, which means we had a $30,000 unrealized holding gain. So in this case, then that would be the amount that we'd be reporting in the other comprehensive income section of the balance sheet. Okay, let's go on to number 5. Number 5, when the fair value of an investment in debt securities exceeds its amortized cost, how should each of the following debt securities be reported at the end of the year? And you're given 4 choices. Go ahead and review the question, stop the video, and when you are ready, restart the video and review the solution. Okay, the answer, well, number 5 is how should each of the following debt securities be reported at year end? And the answer in this case is B. Held to maturity would be at amortized cost, available for sale would be at fair value. This question looks a little bit more complicated than it really is. What it's really asking is that they're basically asking you to classify 2 securities as to their reporting methodology. And you have held to maturity securities, and we also have available for sale. So in this case, what it's saying, when the fair value of the investment in debt securities exceeds its amortized cost, it's asking how should each of the following debt securities be reported at year end. So we just simply follow the rules. In the case of the held to maturity securities, the investment initially is recorded across cost, and on the balance sheet date, it is basically going to be presented at net of any applicable premium or discount. So we don't remeasure that held to maturity security. So it's basically reported its amortized cost. Available for sale securities will be remeasured. So again, it's initially recorded at cost, but at each balance sheet date, securities are remeasured at fair value, and that's exactly what we're saying in B. Available for sale would be measured at fair value. So that's the answer to number. Let's take a look at number 6. For a marketable securities debt portfolio, which is classified as held to maturity, which of the following amounts should be included in the period's net income? Again, you're given 4 choices based upon 3 potential scenarios. So go ahead, stop the video. When you're ready to review the answer, go ahead and restart your video. Okay, number 6. Basically, which of the following amounts should be included in the period's net income? And in this case, the answer is 2 only. Again, if we take a look at held to maturity securities, and we take a look at all these items, basically take a look at the income statement. The basically held to maturity securities includes any amortization of any discount or premium, and if there's any realized gains or losses, in other words, from the actual sale of securities. So in this case, there would be no unrealized temporary losses during the period. Because those, we wouldn't record those unless we actually sold the security. And the changes in the valuation allowance, since there is no change in the fair value, there would be no change in the valuation allowance. Okay, number 7, for a marketable securities debt portfolio classified as held to maturity, which of the following amounts should be included in the period's net income? And we have trading securities and available for sale securities. And we have their aggregate cost, their aggregate fair market value, and the aggregate lower cost or market applied to each security in the portfolio. If the fair value declines are considered temporary, what amounts should this company report as a loss? So again, you have your choices. So when you're ready, go ahead and stop your video And when you're ready with your answer, go ahead and restart the video and review the answer. Okay, and the answer to number 7 is A. Trading securities would show $40,000 $40,000, and available for sale securities would show 0. And remember, the trading securities are going to be remeasured between cost and fair value at the balance sheet date. So that'd be $40,000. In the case of the available for sale securities, although there is a change in the fair value, that change in fair value is taken as basically an unrealized holding gain or loss. It's reported in other comprehensive income, which is not part of the income statement. So that's why it would be 0 for number 7. Okay, now we have number 8. For a marketable securities investment portfolio classified as held to maturity, which of the following amounts should be included in the period's net income? And you're given 3 different scenarios, and you have 4 different combinations of those scenarios. So go ahead, stop the video, and when you're ready with your solution, with your answer, go ahead and restart your video. And number 8, the answer is A, which would be situations number 1, 2. Let's take a look at these situations. Again, these are held to maturity securities. So in this particular case, number 1, a loss in the values of securities that are considered permanent. This would be appear in the net income, because when we say loss in values of securities that are considered permanent, that's the equivalent of impairment. And if securities or any other asset are impaired, we have to recognize a loss. Permanently impaired, we have to recognize the loss of that impairment. Number 2, recognized gains. A recognized gain means that we actually sold a security. So we would recognize a held to maturity security. If it was sold, we'd recognize the gain. Number 3, changes in the fair value at the balance sheet date. Now, in that particular case, those would be unrealized gains or losses with changes in fair value, and those would not be recorded with held to maturity securities. Number 9, Marx had investments in marketable security of $650,000. And these securities were classified as available for sale. At the end of June, the company decided to hold the investments until maturity. The fair value of the investment at the end of December was $575,000 and $530,000 at the end of June. What would the company report as a loss from investments at the end of the year? Again, go ahead and take a few minutes, stop your video, select your answer, and when you're ready, restart your video. The question again for number 9, what would the company report as a loss from investments at the end of the year? And the answer in this case would be A, 0. Again, when we're looking at available for sale securities, that's what they were initially classified as. We would recognize an unrealized gain or loss based upon the market value of the securities at the time of the transfer. Since these were available for sale securities, the loss up to that point would be debited to accumulated other comprehensive income.